So instead of buying 1,000 shares of Amazon for $2,400 per share, which would cost $2.4 million, what if I could just have the option to buy those 1,000 shares if the stock, say, goes above $2,500 in the next 3 weeks? I'd make $1,000 for every point that Amazon goes up. But if Amazon goes down, I'd want to cap my losses. That's exactly what options trading can do. Today on Dumb Money, our lesson in trading options.
This is Dumb Money Live with Chris Camillo, Dave Hansen, and Jordan McLean, streaming live on YouTube. We are Dumb Money.
Hey there, Dave here, along with Chris and Jordan. Together, we are Dumb Money. Welcome to the show. It's Thursday, April 16th. These days, every day seems like a Thursday. We're in a never-ending Thursday, never quite getting to the weekend. It's a time to talk options. It has to be one of our most often requested topics, right? Do an options episode. Today, we're doing the options episode. Yeah, I know that Chris went back and read the now he knows how to teach you. And I know that options, it's one of my favorite ways to trade. Yesterday, I bought Amazon calls. They are up over $100,000 today. Like $106,000 in profits on options that I bought yesterday. And Chris, I know your portfolio is added. Can we even say what your new running total for just the week since Monday?
I'm embarrassed to even say it's 2.5 million since Monday up.
That's mind-boggling.
Almost exclusively due to Amazon, Netflix, Shopify, Peloton, Roku, right, and maybe one or two other stocks, and then a couple that I've been shorting, like Dave and Buster's, and but it's kind of surreal right now, and I don't think there's been a better time to discuss options because
no, absolutely.
Options, you know what my chapter is in my book, Dave, that I named options after? As the chapter is fake it till you make it, because that's really how we got into options when we were teenagers, right? We want to fake it till we make it.
And before we go any further, I did find this really good clip on the YouTube. This genius has a channel where he basically defines all the terms. So in about a minute, here's everything you need to know about options, and we'll come back on the other end and show you how to actually use them. This is my one-sentence option lesson. Options are a contract that lets you buy or sell a specific stock at an agreed-upon price by a specific date. Okay, we'll break it down a little bit more. A contract is just what it sounds like. It's an agreement. It's a legally binding right for you to be able to buy or sell something. I said a specific stock, but really it could be any asset. In my case, we're going to be talking about using an ETF or an exchange-traded fund. And I said it lets you buy or sell. Specifically, that is the right to buy or sell and not the obligation. You don't actually have to act upon this contractual right that you're buying. That right to buy is called a call, and that right to sell is called a put. That agreed-upon price is referred to as the strike price, and the specific date is known as the expiration date. That's the terminology, but it really makes it sound way more complicated than it is. The simplified way of saying how my pause button works: if the stock market goes down, I want to be able to sell at today's price instead of this lower price after it went down. And to be able to have that right, I actually have to buy a contract. The amount I pay for that contract is called the premium, just like the premiums you pay for car insurance. These contracts are a little different though. They trade like stocks. They have their own stock market actually. The Chicago Board Options Exchange is the biggest. It's been around since before I was born. Someday maybe I'll make a video about how I used options before I had any money and was able to afford stocks. And today is that day. So, and I know you actually got me into options. I remember before you were an author and before you knew what you were doing, we were playing the options game. And I remember reading that standardized risk characteristics pamphlet that you get from your broker and thinking, this is the coolest thing ever. Like, if you just deep dive into what these actually can do for you, it lets you take your $100 and control 100 shares of Amazon,
Dave,
like literally right now.
Can we talk about just the whole? I don't know. A lot of the people watching today might be so new to options, they don't even really understand just what it means, like what the purpose of an option really is. Just inherently how an option works. I want to take you through a little story, and this came from my book. And I read it this morning. I hadn't read this thing in 10 years, but I love this story. It's a story about, and sometimes stocks it's confusing talking about this in the context of a security, right? But let's talk about it in the context of real estate, because I think everyone understands real estate easier than they understand stocks sometimes. So I have this story where you are, I don't know, this guy's in Boston or something, and he overhears a Major League Baseball owner who is walking through the hood, right, with the mayor. And he overhears them talking about a new baseball stadium that they were going to put in this area. And the mayor's in on it, and they're going to get approval. And they're joking about this row of houses up on a hill that will be the cheapest and the greatest seats ever for this baseball stadium, because they're going to see right into the stadium. And there's like, I don't know, 20 or 30 houses on the hill. And so you're overhearing this, and you're like, wow, I need to go buy those houses, right? I need to buy one. And you have, you could think you could buy a house for $50,000, let's say, one of these houses on the hill, because it's like the worst neighborhood in town. And you think for sure the value of that house is going to go up to $100,000 as soon as this news breaks that they're going to build a stadium here. So you have two options. One is you could buy a house for $50,000, and when the news breaks, you can sell that property for $100,000 and you make double your money, right? But what if instead of doing that, you could instead go to that homeowner and say, I don't want to buy your house but for $50,000, which is what it's worth, but I want to pay you $5,000 for the option to buy your house anytime in the next 6 months for $50,000, which is what it's worth. And the homeowner's like, I guess that's fine. So instead of spending $50,000, you spend $5,000. And you do that with 10 different homeowners, right? So you take the same $50,000 investment, but you bought the option to buy 10 of those houses for $50,000 a piece. Now, when the news gets out that the stadium is going to be built there, the properties all double in value. And you now have the option to purchase those houses for $50,000 a piece when they're all worth $100,000 a piece. Now, here's the beauty with options. You don't actually have to purchase any of the houses. You could take that option contract and sell the contract to someone else who will then have the right to buy the houses for $50,000. So let's say you sell them the option contract that you bought for $5,000. Now it's worth pretty close to $50,000, right? So you just made $45,000 per contract times 10. So you just made $450,000 off of your $50,000, where you would have only made $50,000 before. So you supersize your gains by a factor of 9 or 10. That's called leverage. And options allow you to get that leverage. It's a very simple way of thinking about it. You could do the same exact thing with stocks, right?
I love that analogy. And that's why your book really kind of dumbs everything down to the point where you can just understand the principles of what's going on. And if you guys want a free copy of that book, just go to dumbmoney.tv/book. We will mail you that exact hard copy for free. We're way behind in shipping those. And if you've already requested one, they will be coming as soon as Chris gets around to packaging them up and putting his kids to work and slapping labels on them and all of that.
I have all my stuff now from stamps.com, so I have everything ready to go to do it.
You've been saying that for 3 weeks.
But I think
sign up. Get your free book here.
But I think let's also talk. Can we dive into those terms a little before we talk about options? Can we just dive into the terms a little bit more, like starting with an option contract? An option contract is the option, but not the, what's the opposite of the word
obligation?
Option?
It's the right, but not the obligation
to buy. set
Yes. So
volume.
if you're talking about a call option, a call basically is where you think the stock is going up. And so let's say a stock is trading for $100 today, and you think it's going to go to $200, but you want the right to buy it at $110, right? So you're going to be buying a call option that is higher than the current trading price. That's giving you the right to buy it there. When it goes to 120, you then have the right to buy it at 110. Now, let's say it doesn't go to 110. It stays at 100. That means you don't have the obligation to buy it at 110. You can just stay back and not buy that option. And the option that you can stay back and not buy it. And so you don't lose that $10. Now, the thing you do lose is the premium. So in order to get one of these contracts, you have to pay a premium.
Yes. So guys, the option contract is, again, the option to buy a lot of stock for a set price anytime between that moment when you buy it and some predetermined expiration date, which you can choose. Generally, most options expire on Fridays. So you kind of pick some Friday in the future. That becomes the expiration date. Now, the value of that option is a combination of two things. That option has what's called time premium. So the more time that's left on the option, the more money that option is going to cost. If you wanted to buy an option that expires in a week, that would be relatively cheap compared to that same option that expires in 6 months or a year, right? So the more time that's left on the option, the more it's worth. As the option gets closer to its expiration date, it loses value. So it loses a little bit of value every day. So if you have an option that has $100 of time value left on it and it expires in 10 days, it will lose about $10 a day until it eventually becomes worthless, at least the time portion of that option value. Okay. So that's what we call the expiration date, and that's what drives the time value of the option. The other piece of value that's in the option, now time erosion, that's a great graph, Dave. The other side of the option premium is the degree to which that option has inherent value, that it's in the money, right? I should know the name for that. I don't know what I need to reread my chapter again. But if you have an option to buy a stock that's currently trading for $100 a share, and your strike price, the right that you have the option to buy that stock at, is $90 a share, then it would inherently be worth $10, right? So you have the time premium and you have how much that option is inherently worth based on how much higher the stock is trading for a call option than what
that term you're looking for is intrinsic value.
Yeah,
that inherent value, the intrinsic value is
value. So we've been doing this for too long, but Dave, can we just talk for a second about strike price, which is so important? What's the strike price? You got, Jordan, you strike price. What is that to you?
What's that?
Strike price. What does that mean to you?
What the strike price? The strike price.
Yeah, like how would you explain it? Because
it's the price at which you can execute that option, right?
And by execute, you mean it's the price in which you have the legal right option, but not obligation to buy or sell that stock at. Mm-hmm. Right, and it's $100 strike price. Right, and you can buy that stock at $100.
And so the difference between the strike price and the current price is basically your spread.
And can we talk just about calls for the first part of this, and then we'll talk about puts later? I think it's easier that way. We're only going to talk about call options right now, which is the option to purchase stock at a predetermined price, which is your strike price, anytime between now and the expiration date of that option, which is usually on a Friday at some point in the future. So now we have a pretty good idea of how options are valued. Let's talk about what an option contract is. An option contract represents 100 shares of stock. This is so important, guys. If you don't get this right, you're never going to understand option pricing. If one option contract equals 100 shares, and options are priced per share. So if the cost of an option, if you're like, how much is that option? And it says it's $5. What's the cost of an option contract? It's actually $500. Because when someone says an option costs $5, what they mean is it's $5 per share. So by purchasing one contract, you have to pay $5 times 100 shares. So a $5 option actually cost you $500. Do you want to talk about a specific option we bought recently to help kind of illustrate this?
Yes. Do you want to talk about the ones that I think you and I are both in, the Amazon April 24th expiration date? So we're talking about the 2,200 calls. So right
the one
now,
we bought
Amazon,
yesterday. We literally just bought these yesterday. So
Amazon
yesterday
is currently trading at $2,400. Yesterday it was trading at less than that.
$2,200 when we bought
$2,300, say.
But it was at $2,240 when I bought mine. Okay, roughly it was at 22. Amazon was trading at $2,230 roughly when I bought my options yesterday. So if I want to buy 100 shares of Amazon yesterday, I would have had to have paid, correct me if I'm wrong, Dave, $235,000, right?
Per share?
No, for 100 shares.
For 100 shares, yes.
100 shares would have cost me $235,000. Or I could have gotten the same 100 shares, the option to buy those 100 shares at a strike price of $2,200, which is about $30 less than it was trading for only $45. But when I say $45, what I really mean is $45 times 100, which is
$4,500.
$4,500 is that $4,500. So for $4,500, I could have controlled $235,000 of Amazon stock. Crazy, right? For exactly 3 days, Dave, 4 days. It expires on Friday, right? For exactly 3 or 4 days. So
you're in the April 17th that expire tomorrow. I actually got the 24th that expire in 8 days from now, 9 days from when I bought them.
And Dave's would have been a little more expensive than mine because he has a whole extra week of time value. But what was so interesting about this option was I actually bought 20 of them, okay? So for me to buy 20 options, that actually represents 2,000 shares of Amazon. For me to have bought 2,000 shares of Amazon yesterday, that would have cost me $4.5 million, right, Dave?
Yeah,
so
exactly.
Instead of spending $4.5 million yesterday on that Amazon stock, I instead spent what was it? 45. I spent $45,000. I spent $90,000. So instead of spending,
I have my example, and I bought the April 24th 2,200 calls. I bought 10 of those. They were they cost $102 each. Means I spent $102,000 to control $2.2 million worth of stock. So those 2,200 2,200 strike price. If I were to buy stock at $2,200, I would be spending $2.2 million. So for $100,000, I got $2 million worth of stock. And if we take that down to smaller numbers, the exact same is true. So that $102 premium that you're paying for the option, if you bought one of those, you're controlling 100 shares at 2,200. So basically, you're controlling $220,000 worth of stock for a price of 102 times 100, so $2,200.
Right. So let's talk about leverage, Dave. So how much leverage? That would have been about 50. Is that about what? How much leverage is that? Let's do the division for me. How much stock you controlling? $220,000 divided by.
It was actually it would be 102 times 100 is $10,200. So it'd be $220,000.
22 times leverage.
$220,000 divided by, carry the one. Yes.
So Dave got 22 times leverage on his money because I was willing to take more risk and buy options that expire just in a couple days that had less time premium included in the option. My options actually had, let me see, I paid $45 for the options divided by 2,200. So what's 2,200 divided by 45? Let's see here. This is important. 2,200 divided by 45, 48 times leverage. So I was able to control 48 times more Amazon, right, than I was willing to buy. Dave was controlled how much? About 22 times leverage? 20 times. Now think about that, guys. What that means is that if Amazon's not going to double, right? But if Amazon did double, instead of just making 2 times your money, you would make 2 times your money times 40, right? Or Dave would have made 2 times his money times 22. So like 50 times his money for Dave. And for me, I would have made 100 times my money if Amazon doubles over that period. But more realistically, what actually happened, Dave, was Amazon went up by about 10% in the last day. Crazy. This is insane, but it did. It went up 10%.
Since we bought it.
And so
it's up 4% of that is today and the rest was yesterday.
So how much is your option? How much you would have made if you bought Amazon stock? You would have made 10% on your money, but you didn't. Instead, you bought Amazon options. And how much have you made on your money in a percentage basis as a result of that, Dave?
Well, let's pull that up. Hang on. So here's my Amazon, and I am up $94,000. So on a percentage basis, 68% since yesterday on these 10 2,200 calls.
Okay, so I am up.
66%.
Mike, I spent $90,000, and my options are worth $408,000. So I made over 400%. On a 10% move in Amazon. So Amazon went up about 10% and the value of my options went up 400%. So you see how much leverage can benefit you, right? And when it goes right, right. But
we also have to talk about the risk, because what you did is you gave yourself 2 days for the stock to go up that 10%. I gave myself 9 days. And so you paid more. I paid more per contract than you by about double-ish, and I had less leverage because of it. But if the market had gone down for 2 days, you would have lost all of your money, and I still would have had 7 days for it to recover, perhaps.
Exactly. And guys, by the way, this is such an anomaly. What has happened to us over the past 4 weeks, 5-6 weeks, all the stuff we've been talking about on Dumb Money Live is such an anomaly. This literally, I've been trading for 32 years actively, derivatives, options, high risk. I had never experienced anything like this or even close to it in my lifetime. This is not normal. I did not expect Amazon to go up 10% in 2 days. I was hoping Amazon would go up 2% or 3%, quite honestly, by tomorrow. So here's what's interesting. I'm going to get to the number one question that gets asked to me more than any other question when it comes to options. Chris, how do you choose a strike price? And Dave, I want to talk about this with you about this Amazon trade.
Yeah, we have a question from one of the viewers asking this very thing. What is in the money versus out of the money? And I don't think that was the one I meant to pull up, but basically the question is, where do you pick that strike price? Why did we pick 2,200s when the stock was trading at 2,300?
No, it wasn't. Well, maybe when you got it, but when I got it, it was trading at 22.30 or something like that, right? Something like that. So the stock was trading at 22.30. I bought the 2,200 call options. When Dave, where was the stock trading when you bought it again?
I really don't remember.
Let's call it 2280 or something like that, right? And you bought the 2,200s. So why did we choose to buy options that were already had inherent value, which is not called inherent value? What's it called, Dave?
Intrinsic value.
Intrinsic value. Why did we choose to purchase options that had intrinsic value in them already, which means they were in the money? If it didn't have any intrinsic value, if the strike price, the price that we had an option to buy Amazon at, was higher than the current trading price, that would have zero intrinsic value. Those would be called out of the money options. Those are riskier options, right? What if we bought an option that was trading exactly, had a strike price that was exactly where Amazon was trading. So if it was trading at 2,300, you purchased the 2,300 strike price options. That's called
at the money.
At the money. So in the money, at the money, out of the money. It's very simple, guys. But what everyone wants to know is why did we choose what we did?
Amazon. I'm just going to pull this up because most brokerages color code in the money, out of the money, that sort of thing. So we'll look at the strike price that you bought. Let me expand this out a little bit and let me share my screen.
And while Dave is doing that, I want to tell you quickly, we will almost always purchase options that are slightly in the money. The reason why we do that is because we are social arb investors, meaning we are generally trading one piece of information or one piece of data that we think the market has not fully appreciated or ingested or reflected in the stock price. And once that gets reflected in the stock price, we think that stock is going to move up or down. But what we understand is that there are other things happening with the stock. There's other things happening with the sector. There's other things happening with the market in general that can cause that stock to maybe go in the opposite direction, or maybe even if the information we have is correct and it starts to move that stock in the direction we think it's going to move that stock, there could be something on the other side that's going to counter that, and the stock might not move up as much as we anticipated. Because of that, we want an element of safety, and that safety is the intrinsic value, because if you buy options that are out of the money, you can make a lot more money on them because they come with a lot more leverage. But if the stock doesn't move up enough, you lose 100% of your investment. And that is extraordinarily risky. Dave, Jordan, we used to do that all the time when we were teenagers, right? And even when we were in our 20s, everything we bought was out of the money. And we lost our money
because they were way cheaper. And so let's just look at this example here. And we see that today, Amazon is right now at $2,408. And if you look down at these strike prices for calls, we're on the left side of the screen here where the calls are. The ones that are in the money are shaded in blue, and the ones that are out of the money are in white. And that difference there, if you just look at the prices, if you're betting that, so we're right at 2,400, so the 2410s are slightly in the money and they are $35, and the ones that are slightly out of the money are $32. So, and you can see that the further out you go, the cheaper they get, right? And if you go all the way down here to the 2490s, you pay $11.95 times 100, so you pay $1,195 per contract. So for $1,000, you could have the right to buy. Am I getting this right? At $2,490.
Yeah. So when I think the next follow-up question people ask is, okay, so you generally buy in the money stock options, and I understand that the reason why you buy them is you guys want to have limited risk on your options, but which ones exactly do you buy? And the answer to that is, we always talk about scenario modeling on our show. We actually apply scenario modeling to picking options. And what that means is, there's other ways to do this, like Black-Scholes formula, where you could actually input, various things like volatility and option premium, and it will tell you which options are the best based on what you're looking for. But
what's considered the fair market value.
Yeah, but that's kind of all takes care of itself, don't you think? I think when I look at an option, we have an anticipation that if the information we're trading is correct, we believe that the stock is likely to go from here to here, for a call option, right? And so what we do is we say, well, if we buy this strike price and we're right, and the stock goes from here to here in this period of time, how much money are we going to make? And we can see, well, I'll make 4 times my money, right? Or 3 times my money. And if it goes to here, how much money will we make? Because lots of times we have different scenarios, right? We're not exactly sure what's going to happen. And so we actually take that option and we run a scenario to determine exactly how much money we would make or lose. And then we run a bunch of those scenarios and we pick the one we're most comfortable with based on the most likely scenario playing out. Because Dave, sometimes we're like, hey, we're not so confident. The stock might only go up like 1%. And if it only goes up 1%, and the strike price is 2-3% above this price, then we're going to lose all of our money. But if we buy something that's kind of right here and it only goes up 1%, we lose the time premium, but we'll probably be able to still keep 70 or 80% of our investment, right? Or 60% of our investment. So it
doesn't immediately go to zero.
And by the way, anybody can do that, right? You don't have to be a sophisticated investor to run scenarios. Just feel like, this is how much the option will be worth. Listen, we know that if we buy an Amazon option at $2,200 strike price and it goes to $2,300, the option will be worth $100, right? $2,300 minus $2,200 is $100. If I paid $45 for that option, I'm going to double my money plus a little bit extra, right? Very simple math.
Yep.
And it's just, you just have to run the scenarios. That's it.
And there are ways to figure out what that time value is going to be worth or what it should be worth. But if you know what that intrinsic value is and you're buying in the money, you're guaranteed that amount. The amount on top of that time value is the variable. So that's what you never know if and especially in these volatile markets, sometimes that time value is way higher than normal. Sometimes it's lower than you would expect, but that whole formula is based on volatility and time.
Speaking of time, how do we pick an expiration date? The expiration date is obviously picked based on when we anticipate the information that we're trading to be disseminated to the rest of the stock market. When will the rest of the world appreciate the information that we think we have, right? All the hard work and research we did, that we think the rest of the market just not appreciating the fact that Amazon is firing on all cylinders, and there's no reason why Amazon should have ever went down when this pandemic hit. But when will the world really appreciate that? And my thought was always this, Dave. I was thinking—
Your thought was 2 days. And my thought was, your thought was 2 days. My thought was 7 days.
Well, it's not like I've been buying Amazon options for the past month and recycling them every few days, right? But my thought was that we would see an appreciation about a week before earnings, which is exactly where we are now. And why do I think that? Well, me and Jordan having spent the last 6-7 years of our lives, working with institutions on Wall Street, the largest hedge funds and quant funds in the world, at a very deep level, using alternative data and educating a lot of these funds on how to utilize alternative data sets. What we've learned is that a lot of these alternative data sets, like credit card transaction data, a lot of the web scraping data, a lot of the web traffic data, a lot of the channel check data, a lot of the things that the world's biggest hedge funds are using to try to front run earnings numbers, okay, usually are coming out days to at max a couple weeks max before earnings, right? And so they're getting that data, they're interpreting it, and then they're trading on it before earnings. So I thought that Amazon, they would likely see what we're seeing about a week before earnings. And that's kind of what's happening now. I think behind the scenes, behind the curtain, you don't know this, but there's a tremendous amount of alternative data that these quant funds and hedge funds are looking at right now. And a lot of it's showing them, I'll give you a perfect example. I'm invested in a company that owns a private company that owns a lot of Amazon stores, okay? And their traffic is up. I'm not going to say the exact number, but it's up considerably month over month between February and March. I know that because I'm a big private equity investor, an early stage investor, and I own lots of private companies. Some of them do business on Amazon. Hedge funds are no different. They have a lot of my partners in that company are hedge fund managers, okay? So they're seeing the same thing I'm seeing. They saw it the same day I saw it. They were like, wow, like I can't even believe this company's business, Amazon business, up this much. If this is representative of all of Amazon, then Amazon numbers are going to be through the roof this quarter. So those are the things that retail investors don't really get to see that often because they're not that deep into the financial markets. They don't have that type of inside intelligence into things that are happening that are just kind of correlated usually, right? So you know that when this company does well, usually that's a good sign for this other company, right?
And I know that now that, you yesterday bought these 2200s because you were selling some at a lower strike price of 1800. And I had the same ones. I had some 1800s that were expiring on April 24th that I sold and I bought twice as many of the 2200s for half the price of what I sold my 1800s for, right? And I picked the 24th, April 24th, because Amazon's earnings come out after the market on April 23rd. So I have the entire time leading up to the actual earnings announcement, and I'm going to make just an evaluation as to, do I think that that Amazon is going to have all of its gain leading up to that event of the earnings? And do I sell before the earnings just on that run up in anticipation of perhaps something being said in Amazon's earnings calls that spooks the investors in the stock and makes them sell, or people like wanting to take their profit at this new 52-week high that Amazon is at? So that's why I picked the 24th. So I would have the ability to decide, do I want to sell the day before options, or do I want to actually wait for that earnings announcement and sell on the one trading day that happens after earnings?
By the way, I do want to get to one question because I just saw it. I think it's really relevant right now because we're talking about option pricing. Jordan, I know you've looked into this some too. Danny H, 1137. Do market makers dictate the option prices, or does volatility dictate that? Jordan, could you kind of explain how volatility, from a mathematical standpoint, impacts option premiums in general?
Oh, yeah. I mean, I don't know the actual formula or anything like that.
Not the formula, but just the concept behind it, right?
Yeah, anytime you have a higher VIX level, that'll take, the option price will basically increase, right? Because there's more risk to the issuer.
Yeah, so basically when volatility goes up during times like now, stock prices are going up and down by like huge swings. You can make a lot more money with these options. And the people that sell the options to you, the option writers, which maybe we'll touch on later in the show,
yeah,
they're not going to just write you options, right, to buy a bunch of stock when the stock is shooting up and down for the same price they were when volatility was low and prices were going like this. They're going to charge you more. So it could cost you double the premium to buy the same option that you could have bought 2 days ago when volatility was like this, when it started going like this, just based on the fact that volatility has increased. And that's why a lot of this month we've been talking about the fact that we haven't been purchasing a lot of options the past month because the premiums were so high due to the massive volatility.
For a good example is what we were using to hedge our portfolios was buying put options on the SPY, the S&P 500 ETF. That the premiums got super high on that because unlike normal times where the entire market goes up 1%, down 1%, you're not seeing giant changes overnight. We were seeing in one day the market going up 10% or down 10%. And so when you have those kind of big swings in something that traditionally trades in a much more narrow range, you're going to see higher premiums for the options. And so it got really expensive to continue to buy put options on the SPY. And so what we ended up doing is just directly shorting shares of the SPY. And so that's where if options don't make sense and you have enough capital to be able to just buy the underlying stock, you're able to avoid that super high premium.
But you lose the leverage. And so
you lose the leverage.
So we talked about how market volatility increases the pricing of options in general. Well, volatility for the specific stock itself can also increase the option pricing. So if you're trying to buy options in a company that's about to have a lawsuit verdict come out next week, right? And if the lawsuit verdict is A, the stock price is going to shoot through the roof. If it's B, bad for the company, the stock price is going to drop through the floor. So the market is not dumb. Everybody knows that lawsuit verdict is coming out next week. They're not going to sell you options cheaply on that stock. So even though market volatility might be really calm, you might look at that stock and go, wow, the options are so expensive. Why is it? It's so expensive for me to buy leverage. Well, obviously, because who's going to want to sell you that leverage on the cheap when they know that there's something that's about to happen that would cause massive volatility in the stock price. So there's no shortcuts here, guys. There's no way to kind of cheat the system. It's an efficient market, meaning the option prices are priced appropriately for what is currently known about that particular stock, that sector, and the market at large. So don't think you can kind of outsmart the option writers. It's not about that. It's about outsmarting them by knowing something that they don't know.
And it's really just like a stock. The same efficiencies that sets the price of a stock. When more people want to buy it, the price goes up. When more people want to sell it, the price goes down. There always has to be a buyer, whether it's an actual individual who's selling that option or it's a market maker who is selling that. There's a bid and an ask, and there's a price that someone is willing to buy and someone is willing to sell, right? And I think you go into that in your book when you talk about, you have to think of it like you're buying an actual tangible thing, where every time you're buying an option, there is someone selling you that option.
Yeah, exactly. And by the way, we've focused right now in this conversation about call options very quickly. Put options are the exact same thing, just the opposite. So instead of having the right but not the obligation to purchase a lot of stock at a set price between now and some predetermined date, you have the option to sell a certain stock at a set price anytime between now and some certain time in the future. That's the expiration date. That's the only difference. And you buy a put when you think the stock's going to go down. It's very simple, guys.
Yeah,
right?
and if let's explain that a little bit more. You buy it. I see a lot of our people in the chat are very sophisticated and want to know more about our strategies, but a lot of other people are watching this because this is really a lesson for beginners as well. So if you think a stock is going up, the reason you buy a call is because you want to be able to lock in a price that is lower than where you think the stock is going to go. So you're buying that call. As the stock goes up, you want to be able to buy it at this lower price. If you're buying a put, you think the stock is going down. So you're picking a predetermined price that you would love to sell the stock. And if the stock goes below that price that you've predetermined that you would like to sell it for, you then are making money because you sold it here and the stock has gone down. It's the same buy low, sell high mentality that you have heard forever. That's how the stock market works. The options market is the exact same. So you're buying a call when you think things are going up. You're buying a put when you think things are going down. And I don't know if we'll get to it later in the show, but there's more sophisticated ways. There's all kinds of things that we really don't do. We don't do these multi-leg buy a call and sell a put kind of strategies. That's beyond the way we use options. But the one thing that we might do is if we own the stock, if we had, say, 1,000 shares of Amazon that we wanted to write or sell the call, there is an income strategy that we might get to a little bit later. And also a lower cost way of buying stocks would be to sell puts. So that's where we get sophisticated. And Jordan actually just today was buying some Amazon, and I was telling him, well, you should have just sold some puts and you would have the same effective result selling those puts, because you're basically selling a put, which is the right to sell. So you're making yourself obligated to buy it at a predetermined price if you sell a put.
Can I say why we don't get sophisticated with options? We only trade options. We only trade in general when we have fairly high conviction that we have information that the market hasn't fully digested or appreciated, right?
Yes.
And so if we feel that way, we're looking to actually trade with conviction, meaning we want to trade with leverage. We are not looking to kind of wrap our options and all this fancy stuff. It's not how I've ever traded in 32 years. I'm never going to do it. I don't want to think about it, because if you're thinking too much about construction of derivatives, then you're spending less time thinking about the important stuff, which is the information that's driving
the drivers. What is going to make this stock do what you think it's going to do? And the complex methods typically put you in a range where if it goes above something or below something, you're going to profit, and it caps your losses or gains on either side. And it's really not, we're looking to have unlimited upside and capping our losses. That's really all we're generally using options for.
Yeah, and I don't want to rip all the people that do that, but I kind of will. But I don't want to. But listen, I mean, I'm sure everyone has their own thing, and that's totally fine. There's different strategies, but for our strategy, there is really no way that you're going to generate the returns that I generate with that type of a strategy. It's just not really possible. And like, let all these sophisticated people do it. They're not making the kind of money I'm making. They're just not, okay? So they're not making the kind of returns I'm making because they are confused by noise, structural noise, mechanical noise.
And they just have a different objective. You're looking to double your money on a single trade. They're looking to maybe place 50 trades a month and have each of them give them a little bit of income and limit their losses. So there's just different strategies.
Well, no, not necessarily. I think we all have the same objective. Their objective is to do the best they can with their limited ability to gain knowledge that other people don't, because they're not good at doing that. Okay. If anybody has the ability to be good at what we do, we're not that smart. I'm sorry. We're smart, but we're not that smart. There's nothing that we do that anybody couldn't do. When people say, Chris, have you generated, 80% annualized returns annually for the past 13, 14 years, turning tens of thousands into 8 figures? How does that happen? It happens because we're focused on a strategy that works, and we don't get caught up in the noise and all the BS that 99.9% of other investors and traders do. Listen, everybody wants to make a lot of money, right? For the most part. If you can't make a lot of money, then you try to do these other strategies to maximize a point a year over what you might have gotten without the strategy, okay? It's just not what I do. By the way, this is a great time to say we're not financial advisors. We're not advising you what to do. We don't know your risk tolerance. We know our risk tolerance, and that's the only thing we know. So do not do what we do, but learn how we think. And if the way that we think is appealing to you, you can use it as an educational tool to develop your own strategy or spin-off of our strategy. But certainly, we're not telling you how to trade or what to do in your account, because we don't know what your risk appetite is. And that would be irresponsible of us. So
we're just wanting to kind of shed light on the way we do things. And if you watch these live streams, if you come back every single time we do one of these, over time, you're just going to, I hope, pick up a way of thinking about investing that may be different than what you had thought in the past.
Sorry, guys, I'm getting my generator installed. Oh, here's my. Sorry, give me 1 sec. Okay.
Okay. Let's just pull us closer together. There we go. So let's talk about your specific trade today. You bought some Amazon, and let's look at an option strategy to have done the exact same thing, but in a slightly more sophisticated way.
Yeah.
So you basically bought shares, right?
Right. I bought about 100 shares of Apple today. Or I'm sorry, not Apple, Amazon. Just early this morning. Straight up shares.
Straight up shares. You were buying it at maybe $23.80 or something, right?
No, it was like $23.50.
$23.50. So let's pull up options, and let's say you wanted to buy at $23.50. Okay, you could have, and we'll just say you like the price $23.50. That's a great price for you. So you could have sold some $23.50 puts that expire in just 8 days for $67.70 per contract. So you bought 100 shares, you would have sold one contract, and you would have profited $6,700 just by selling the contract. Now, you don't actually have the shares at that point. You only have the shares if the stock were to go lower than $23.50, right?
Yeah.
So you would not be put those shares. They wouldn't be put upon you unless the stock dropped below that price.
Right.
But you have that $67 regardless. If it stays up, you've made $6,000 profit. If it goes down to $23.50, you still made that $6,700. And if it goes below you still have that $6,700 and you're forced to buy the stock at $23.50 where you wanted to buy it anyway, right?
Yeah.
If it went down to $2,200, you're still required to buy it at $23.50. So you basically are now buying stock at a higher price than you could on the open market, but you basically got a $6,700 discount. So you're basically buying the $23.50. You're in essence paying 22 and change. I'm not good at math, but you're basically getting a discount on the stock. So that's kind of the thing that I was saying, that instead of just straight up buying today, you could have locked in some profit. And then you also have the benefit of, if the stock were to go down, you own the stock. If the stock were to go up, you have guaranteed profit, and you could continue to sell more of these, knowing that you're not going to end up buying the stock, right?
So is that what, did you do this?
I haven't done that yet, but I think but the next straight up shares that I buy of Amazon will be done in that manner. I'm going to plan to buy the sell puts and hopefully get the stock that way. And I have several other positions where I have done that. So let's switch us so that we're in the right order for consistency. And welcome back, Chris. We were just giving a little lesson on how you can actually buy stock through selling put options. And it's a way to basically get stock that you want to buy anyway at a set price, today's price, at a discount by getting the guaranteed premium. And if the stock goes up, you don't get the stock, but you can keep selling more along the way.
Yeah, so that would work in a strategy where you had pretty good confidence that the stock was a stock that was going to do okay, you know, in the short term, but you didn't think that there was a likelihood that it was going to go up a tremendous amount and that you're going to miss out on.
Because you are capping your upside.
Capping your gains, right?
Yeah. So it's a very specific situation.
And so you really have to think, like, what is your strategy, right? And so, and what do you think is going to happen with the stock? Like with Amazon,
I think your strategy is you're like a long-term holder. You want to buy Amazon and just keep it for life. So had you done this, you basically are guaranteeing yourself some upside, and you could keep doing this along the way up as it goes up and actually make more money than you would have in just buying the shares that you bought today.
Yeah.
But if it went down, you've basically locked yourself in at a discount to that strike price, and the discount is the premium that you sold.
Let's look at where that goes very wrong for Jordan. If on the day that we purchased our call options, Jordan would have sold those puts or whatever, right? Mm-hmm. He would have gotten screwed because he would have gotten his measly premium on the puts, missed out on a massive upswing in Amazon stock, and now he'd be screwed. He's like, right? That would be a terrible thing for you if you did it that way back when we did it. So,
so I think the better thing to do when you're looking at something like Amazon, where you see that this is, and the reason that we're talking about Amazon right now is because we think there's a huge benefit to the current situation. And so we're looking for ways to capture that upside, right? And buying stock is one way to capture the upside. And then the other one is by buying call options.
Yes. So just, I think that the takeaway here is every fancy option strategy has its positives and negatives, right? None of these, like, so many option traders think that I can't even tell you how many times people come to me, I have this foolproof option strategy. It reduces the risk down. I'm like,
I used to come to you with those strategies, and every single time you poked enough holes in them, I'm like, yeah, it's not even worth it. I get it.
For any amount of risk that the strategy is reducing, it's also taking away from something else. You don't get to let me explain something. You don't get to remove risk in financial markets without a price. There's always a price to removing risk. Just like there's always a price to your leverage. You want more leverage? There's a price to it. You want to reduce your risk? There's a price to it. Don't let anyone else tell you that there's this magical option strategy that just, works for everything. And it's just, it doesn't exist. Okay. So by the way, random question. Am I still shorting Carvana? Yes, I'm still shorting Carvana. It's a very small trade, but I am still shorting Carvana. Oh, I emailed you a long time ago waiting for that book. I am the worst mailer of books in the world. I feel so guilty. Don't make me feel any more guilty. We
have probably 3,000 people on the waiting list now.
Okay, here's the deal, Dave. I know what I'm going to do. I figured it out. Because you know when something you get so overwhelmed with something, you just don't do it? I'm going to do like 20 a day. Like 24 a day. Like one box a day of books.
See, I feel like it'd be better to just rip off the Band-Aid and do them all.
Rip off the band. No, I'm gonna. I have so much anxiety right now. I can't handle the thought of mailing out thousands of books. I'm gonna do.
I say
one
what
a day.
you need to do. No, you need to get the labels printed first. And once you have the labels printed, your kids are stuck at home. They're not going to school. They're finishing their online classes pretty early. Just put them to work, slapping labels on and sealing them up and putting them in a stack.
But to start, I need to start. I'm going to start by just doing a few days in a row of like 24 a day. I got to go through the whole process of stamps.com and the labels and all that stuff. So sorry. I'm sorry. I will get them out. I promise I'll get them out.
And the place, every time we mention it, someone wants to know, dumbmoney.tv/book is where you go. And that's, and just fill out the thing. Let us know how you found us, that sort of thing. Because it's, we love our fans. We love the people who watch us. And it's, we actually, this live thing it kind of was born out of, not being able to hang out and go to lunch and film our episodes. I love doing this live stuff. We're doing it at least twice a week now. And it's the only time I get to see you guys.
And I just wish, Jordan, you would send us some of your barbecue for these episodes. You should have them favored here the night before. You could warm it up. Can I say this is a question that comes up all the time too. Rob at 11:17. When is the right time to take profits? Do you let it ride, or do the option price goes up too much and it's deep in the money? It gets harder to sell. I haven't been able to understand that. Rob, I'm going to tell you a very simple answer, and it translates to options the same way it does with our equity. We initiate a position when we think we have information that the market doesn't have or hasn't appreciated on a particular stock. And we exit the position when we think that information is either no longer relevant or when that information has been disseminated to the investing public at large. That's it. Doesn't matter if we made money. Doesn't matter if we lost money. Nothing else matters. In fact, I used to say that the best way to trade stocks with our info arb strategy is to close your eyes and not even look at what the stock's at. If you could literally trade in and out without ever knowing if you made money or lost money, just trade on the information dissemination within itself, that would be the best way to do this. No one has the ability to actually do that. But but once you have, if you have some thesis, and once you see a news story come out tied to the stock that you're talking about with that information, you know that it's time, because now everybody has that information, and whether the stock has made a move or not, you know that what you were thinking has now been priced into the stock. Yeah, or an analyst report, or a company announcement, or just people in web boards discussing that thing that you thought was so, interesting that no one else appreciated. As soon as that comes out to light, that's when you exit, unless you have a new piece of information, right, that you want to start trading. It's that simple. What else we got here, guys?
I couldn't go that far back in my. I lost the history of my of the chats here, so I can only look at the more recent ones.
Old comments, but go ahead, Dave. Let's see. Question.
They want Jordan to send some barbecue with each book. That would get kind of gross.
Might make the pages a little soggy.
Oh, Leon says max loss is what you use to buy. I don't know what Leon's saying, but let's just state for everyone, the most you'll lose in an option is the amount you paid for the option. It's not like shorting stock where if you buy a put, you can lose your money plus more. If you're going long an option, meaning you're buying a call or buying a put, the most you will lose is that money. And you almost never exercise the option. That's when you let the option go all the way to the end, and then you
because if you do exercise, you have lost some time premium, and you can always, up until the minute before it expires, there's going to be a slight advantage to selling the option instead of just being put the stock. If you have a calling the stock, if you're short, you're gonna be better off selling the option instead of letting it actually expire, because of that time value that's on top of the intrinsic value.
Yeah, and by the way, Will Holmes 1125 says premiums move differently than stock price. Generally, premiums move directionally in the same way as stock price, but it's not perfectly correlated, because remember, the premium there's time premium there and there's intrinsic value. So the time premium is always eroding, right? You're losing money every day on that time premium. That's always going down. So if a stock just stays even, the option price that you have by definition would go down every day. Like
well,
if
we
the
saw
stock
something really interesting when the VIX was dropping from 80 down to 50, is that all of the option values were dropping also because that change in VIX was happening kind of in real time. You normally don't see that because the VIX is normally somewhat stable.
Yeah, that's super, super rare,
Right.
but you're totally right. Like if something happens that would impact the volatility of the market or your stock, that in itself would cause the option to go up or down, because that volatility premium could go way up or way down in your stock. But listen, those things generally, as a general rule, don't usually come into play. This is extraordinary times that we're seeing stuff like that. Let's see.
Do you want to talk about leap options?
So yeah, I mean, leap.
It's basically just an option that has a way longer time horizon. So if you are taking this Amazon example, if you were to think that Amazon, you don't know if it's going to, you're not really playing the information the way that we typically do. And this is why we don't generally mess around with leap options. But the thought process is, if you think that you don't know if Amazon's going up or down this quarter, but you think Amazon is going up by January of this year or January of next year, you know what I'm saying. You could buy, and they're expensive because the time horizon is so long, but you could buy a leap option to buy Amazon at a price that you think it's going to be, it's going to beat that price in the long term. Now, the one place I would use a leap option is if I'm selling a put. You get a huge premium for a stock that you're willing to buy at that price today. That's something that I was looking at when Amazon was at what was it, 1,600, 1,800, something like that. If you had sold January 2022 puts, in January of 2022, I think that Amazon is an $1,800. That's a great buying price, and you could have made like $1 million just in the premium for selling that far out.
Also, guys, one thing where leap options are kind of cool is that if you buy a leap option that is more than a year away from today, and you keep that option the entire period before you sell it, then you qualify for long-term capital gains, which could be a beneficial tax rate depending on what tax bracket you're in. So, we generally don't do it because they're very expensive. You don't get a lot of leverage with leap options because there's so much time premium that you have to pay. You usually only get like 2 or maybe 3x leverage on that. By the way, you would have, Lars at 1129, you would have lost all your money with no shares to show for it. Most people cannot risk a $100,000 bet. Well, yes, options are not for everybody. They're not for everybody. And by the way, the amount that we invest, it's all relative. You don't have to invest $100,000. You can invest $500. You can invest $50 in an option, right? You can invest $30 in an option. Every
number that we say, you can just hit divided by 10 or 100 or 1,000 and do the exact same thing.
Yes,
because your percentage gain is going to be the same.
Correct. Now, on a stock like Amazon is really expensive. So you might not be able to ever afford buying an option that's in the money on Amazon, and that's okay. But we're here to talk about the process, the thought process we go through, and it is exactly the same whether you're investing $50 or $500,000 in an option. It's the same exact thing, guys. So don't get caught up in how much money we're investing. It's completely irrelevant. When we started doing this, when we were 13, 14, trading my older brother's account, I was literally trading options sometimes $20, $25. Like I was buying one out of the money option, losing 90% of the time, but I was buying one option for 20. Remember, the chapter in my book is called "Fake It Till You Make It" because we got addicted to options when we were kids because we can play with this big money for just a little bit of money. Now, most of the time we lost all our money, but if we were right, we could literally make 10, 20, 30, 40 times our money with now the money options. So that's kind of how we got started.
But to go back to my example of what a leap option could do for you, this is today's, as Amazon keeps going up, we're up 4% now, and they're at $2,400. Let's say you wanted to buy Amazon's a great buy at $2,400. Jordan, you bought some today at $23.80.
50.
If you go out to January 15th, 2021, and you were to sell these puts for $284, so each one is giving you $28,000, each one you sell, that is basically giving you a $284 discount off of this $2,400 price if the stock were to go below that number. So it's like, but it guarantees that you're going to make $28,000 today by selling it. It's capping your gains at $28,000 because Amazon's going to go up. So you're just capping your gains at $28,000 for that one option. But if it were to go down, you've essentially, if for some reason Amazon went to 2,000, you basically are required to buy it at 2,400, but you got guaranteed $284. So you basically bought it at 2,100. That's all I'm going to say.
Yes.
Done.
By the way,
we can move on.
Steven at 1130 says, if the stock went up $100 on 20 contracts, profit would be $200,000. That's correct. The option is to purchase 2,000 shares, right? Yes, that's correct. Because one option is 100 shares. So 20 options is 2,000 shares. But you don't actually have to buy, then sell to take profit. Correct, Stephen.
Correct.
Exactly what I've been saying. You don't have to buy any stock or sell any stock. You never have to do that because
you can simply buy your option and sell your option.
Yeah, there's a market for the options.
yes, yeah. There's just like a stock. There's a market for the options.
Yeah, they trade just like a stock. They have a buying price and a selling price at any time, and any time before they expire, they're just like a stock. And as soon as they expire, you can't buy them or sell them. And if you own a option that is in the money at the time of buying or selling, you have automatically executed that option, which means you do have to have enough money to buy the underlying asset.
So
if it's out of the money and it expires worthless.
Yes.
Someone is asking Dave, Evenji Barsky at 11:30. I'm sorry, yeah, 11:30.
I can't go before 11:42. That's when I refreshed my page.
Okay, so the question was, Chris, wanted to hedge against month-end portfolio rebalancing. Which option? Would you?
We were talking about this yesterday.
Yes, yeah. So he said, which options would you buy? So what I would buy, which is not what you should buy, but what I would buy. So I have this thesis that the market is going to rebalance their portfolios. All the big funds and the pension funds that have to be 70% equity, 30% bonds or cash. They've made a good 15% this month in the market, 10, 15% this month in the market. So on the equity side, and they're going to be forced to sell some of that equity at the end of the month, the same way they were forced to buy more equity last month, right? More stocks last month at the end of the month. And that traders, the same way last month, a lot of the hedge funds actually front ran that trade into that last week of the month. I think they're going to front run this same trade this month. Maybe not as severely, but they're going to do it in the opposite manner. So I think you're going to see potentially maybe a chance of selling into the end of the month that will get front run starting on Monday, maybe even starting tomorrow, maybe even starting today. It could have started today for all I know. So I would buy the options that actually expire. I know this sounds weird, but like next Friday, even though the month doesn't end until the following week, I'm thinking that people are going to start front running it a little bit earlier. So I'd probably get the SPY puts that expire next Friday, the 24th, or more conservatively, you get the ones that expire on the 1st of May, right? And I would buy them pretty much right in at the money or slightly in the money, like we've been talking about all episode. Maybe a couple percent in the money, Dave, wouldn't you say? 1 or 2% in the money?
I would, I'd probably be looking at that 1 to 2%, but I also like to have them that are on even numbers just because those have more volume. In something like the SPY, there's probably enough volume in any of them, but if you're buying something.
If the SPY's at 277, would you get the 280s?
Yes.
Puts, the 280 puts.
280 puts.
Maybe I would probably buy the 280 SPY puts that expire either next Friday or the following Friday. If I wanted to apply that strategy that's what I would do. I actually have SPY puts that expire in the third Friday of May. So that's
do you have the 280s?
What?
Do you have the 280s, Chris?
I do. I do. I have the 280s. I actually had the 270s, and I sold them, and I got the 280s this week.
Yep.
And I doubled the amount I had, so now I have 400, and that could change any time.
Yeah.
It's my one little hedge on the portfolio. What else we got here, guys? Any good questions?
Can you explain why people and what type of people sell options?
Yes, absolutely. There is a type of person who sells options. They do it generally for one reason: income generation, cash flow.
Because you have a predictable amount of income, but you're capping any kind of extreme gains.
Yeah. So the person that sold me those Amazon options basically for a $2,200 stock made $45 in 3 days. So if you think about that, $45 divided by 2,200 is 2%. Ready for this? So whoever sold me those Amazon calls that I bought yesterday, Dave,
yes,
made 2%. They basically own, let's say, that Amazon. They just own the stock. They own it, right? Yeah. They made 2% for 3 days.
Their gain at 2%.
Yeah, guaranteed. That's
and you got everything after that 2%.
Yes, correct.
And
so
when the
basically,
stock made a huge move, you came out way better than the guy who sold you those options. Now, had Amazon stayed flat to going down, he would have made 2%. I assume it was a he. She would have made 10%, 2% regardless of how far it went down. And you would have lost all of your money.
But let's talk about the mindset. It's probably not someone that had Amazon. It's probably someone that said, hey, I think that Amazon has very little downside in the next 3 days, but I don't necessarily want to play the upside, but I'm comfortable that it doesn't have a lot of downside. So I'm going to buy Amazon stock. I'm going to immediately sell an option right around the current price, which is where I bought it. And in the next 3 days, I'm going to make 2% on my money. So if they put, it's incredible, make 2% of your money in 3 days. They know that they're going to not make any upside on that beyond the 2%, no matter how much.
But they're locking in a 2% in 2 days, which is a great return.
But do you know the risk?
If you think about what the risk is, you don't. The
risk is they're stuck with all the downside if something happens. So guaranteed 2% upside. But if Amazon goes down, and I just lose my premium, they can lose all of it. They can lose all that money they spent on the Amazon stock. So if it goes down more than 2%, they're now losing money, right?
But you were just describing what we would call a buy right, where you're buying the stock and writing an option on it. So they're not actually unlimited losses. They're just not getting any additional gains because they own the stock and it's going to be taken away from them, right?
No, it won't. No. So if they buy the stock and write calls on the stock, they then take all the losses on that stock. If that stock goes to zero, their entire investment in the stock, the $2,200 per share they bought, it's gone. They lose all the money on the stock because they have to own the stock to write the option on the stock, right? So they have all the downside.
That's true.
And none of the upside. But what they do have is a guaranteed 2% for over 3 days. That's the premium they get for taking all that downside risk and giving away their upside is they get a guaranteed 2%. So they're pretty confident that Amazon's not going to go down more than 2%. And they don't really care if it goes up more than that. They're like, I'm not thinking about how much it goes up. I just want my 2% guaranteed. That's the way they're thinking about it. Hey, there's a lot of people that do that. And you got to realize there are a tremendous number of financial institutions and institutional money that must generate cash flow. And option writing is one of the primary ways in which they generate cash flow. A lot of times what they will do is they will protect their downside to some extent by basically buying puts on Amazon that are like further down the chain, right? So they made 2% selling me a call, but then they'll spend half of that money to buy puts to kind of cap how much money they would lose in a worst case scenario where Amazon started to go down. So instead of making 2% on their money over 3 days, they're only making 1% on their money over 3 days, which is still an incredible interest rate, 1% over 3 days. And they can lose money, but they're not going to lose their pants, okay? Because they have puts that maybe cap their losses at like 4%, let's say. So the most they're going to lose is 4 or 5% of their money in a worst case. So that's kind of how they think about it. By the way, people that do that, it's a whole different mentality. And it's something, it's kind of, we call it, well, I mean, you're just capping your gains, right? You're just capping your gains. So it's a different mentality. It's not the way I think.
It's an income investment, and yeah. So can we buy options with a time frame or expiration of 3 months? Yes. Generally, most stocks that have options that expire every month. It's usually the third Friday of the month. Sometimes they're weekly options that expire every Friday, but most have a monthly option that is the third Friday of the month. And generally the leap options go out to January and often various other months in future years. What kind of fees come with options? It looks like Chris left again.
He's gone.
Bye, Chris. All right. So what kind of fees come with options? If you're trading through an online broker who no longer has fees for trading stocks, generally they also don't have a fee for trading options, except sometimes they have a per contract fee. So check it. It really depends on your broker. I know that I'm with Schwab, and they don't have I believe they don't have a fee on the actual trade. Used to be like a $30 plus 30 cents per contract. I think it's just now the 30 cents per contract.
Yeah.
Don't quote me on that, but that seems to be. I think that that's the price point. And Chris is back now. Where do you keep going?
I had to approve the bank wire, the $100,000 bank wire I told you about for our super secretive startup investment that we're funding that we're not going to talk about on this channel.
Nope. You got to subscribe to our other channel, Dumb Money. Ding. We have too many things on the screen right now. How do I get rid of this one?
My bank, by the way, I know you're going to rip me on this. Wells Fargo does not allow you to wire money.
How are you with Wells Fargo right now?
They have a $10,000 cap, right, on what you can wire through your laptop. And so otherwise you got to go into the bank in person. I literally went nuts. I was like, you know how neurotic I am. I'm like, I'm not leaving my house. I don't want this virus. I'm not going to walk into the branch. We got to figure out a workaround. So now they have this whole system for me where they're getting approval from corporate every time. I know how many bank wires I do, twice a week, right? 2-3 times a week.
I just don't understand why you're even just go on Google and say Wells Fargo fraud. You really want to be with that bank? And also, how did your payroll protection plan loan go? Trying to process it through Wells Fargo. You talked to the branch about that, right?
Oh, no, that was for one of my portfolio companies. Yeah, it was a nightmare. It was a night for them. We have a nice private,
we have a small local bank we both used.
By the way, we got our money just in time, Dave. They cut off.
It's out, PPP. Right?
Yeah, they're out of money. We got our money.
We got ours wired yesterday, and we cut checks that are being delivered to our employees. Today's Thursday. They're getting them tomorrow. The first round of checks for 8 weeks.
We're paying 70 employees, most of them, to sit at home. Exactly what they made waiting tables with their tips and everything. They're getting. Basically, we average. For those of y'all that want to know how this works, we have a restaurant, 70 employees. We basically take the average of how much money they've made, over the past year.
Salary and tips over the past year.
And we're just writing them a check for that every payroll. So they're getting full compensation. It's coming from the government. The government gives us the money. We give them the money, right? And then it's really weird, but that's what we're doing. And a lot of them are telling us, no, thanks. I'd rather have my unemployment, which is actually even more money. Some of these guys are making $1,100 or more a week on unemployment between the Fed money and the state money, and that which is so much more money than they ever made as a waiter working 2 days a week, right? I mean, it's insane.
Yeah, we had the same. So you have 70 people. We only have 8 people that were on this plan, and of those, 2 of them chose not to take the payroll because they were going to make, because they were more part-time. They didn't work as often, and so they're going to make more in unemployment. But I think, I mean, who knows how long this 8-week period is, how far that will go. I don't think that your business or my business will be open by the 8 weeks, but hopefully it gets extended and we can keep paying our people.
Yeah, and by the way, here, a little lesson learned here. Dave's bar that he owns with our friend Lynn, and I own this restaurant with Lynn, his bar makes probably more money than our 70 employee company makes. So lesson is, if you're going to open a bar, do one that doesn't have food. Okay.
We have a whole video on that. If you go to the original Dumb Money channel, youtube.com/dumbmoney, look for the video called Worst Investment Ever. It's all about the restaurant and bar business and another local restaurant bar that we invested in that I don't even know how that's doing through this.
They got to be doing terrible, Dave. Right? I mean, I'm so worried about that.
It's a huge operation.
I'm so worried about that's the worst investment ever right this second. And by the way, that is one of the coolest episodes ever. If you guys haven't seen that, you must. It's so fun. We've gotten so many compliments on that episode. Watch it now more than ever. You want to watch that episode. It's a good one.
It's a good one.
And like that episode, but also please like this channel right now. Just give us a thumbs up. The YouTube algorithm is never going to show our videos to anyone if we don't get a lot lot So we really appreciate it.
I made that graphic. Okay.
Oh, nice.
It's animated. I can just leave that on the screen the whole time.
Oh boy. Hey, by the way, I don't want to get too into all of these trades that we're doing right now on this episode because I want to save it for Monday, because Monday's episode, guys, is all about what people are spending their stimulus checks and their unemployment checks, and everybody is they're a bunch of people are hurting right now, but there's actually a lot of people that are cash flush because they're not spending any money and they're
their
making
expenses
more
have
money
gone down, and they're getting continuation of paycheck or unemployment that might be more than they were making before, and a stimulus check. And this new stimulus package that they're working on looks like they might give $2,000 per person per week, or is that right? Per month? I don't remember. But there's a new stimulus bill that was just introduced in the House yesterday, I believe, that is a ongoing, I think it's $2,000 per month per person, and they're trying to find ways to include students who were excluded before, college students who were being claimed as dependents on their parents, or older parents who are being claimed as dependents by their adult children. It could be fascinating if the whole economy is starting to be based on everyone getting this universal income.
Well, and we've been doing a lot of work, doing a lot of research, have some really cool trades that we are contemplating heavily right this second that we'll probably pull the trigger on over the next few days, and we're going to talk about on Monday's show. So if you haven't subscribe and hit that bell to make sure that you get notified of Monday's episode. It's 11 a.m. Central, 12 p.m. Eastern, right, is when it comes on. It's going to be a really fun one. You definitely don't want to miss on Monday. Yeah. Talking about Ford, right, is one of the ones we're going to talk about on
we're going to talk about that. We're going to be talking about Amazon. And Brian Cruz lets us know that Amazon physical store visits were up even with the stay-at-home orders.
Physical store?
That's a question.
What do you mean, Whole Foods or that 4-star store in Manhattan? What is he talking about?
Yeah, I don't know. Brian, let us know what you're referring to there. Evil Genius has a question for Jordan, because you are the more conservative investor among our group. Weigh in on when you use options.
Yeah, I'm not as heavy of an option trader as Chris or Dave. When I'll tend to use it is when I'm completely invested, don't have too much cash, and I just want to, we'll get some idea about something like a chicken restaurant or something, and I want a chance of that upside, so I will.
And actually, so as really, a conservative investor, right? Chris and I, there's this certain chicken restaurant, the Popeyes trade, also on Dumb Money original channel. You should go watch the worst. That's our other terrible investment where Chris and I lost $1 million or something, and Jordan using options had all of the upside. He had amplified his upside, but limited his downside to losing all of his money in the options. But that downside was way, way less than the $300,000 we lost in a single day, I think.
Jordan, how much money did the $1 million that we lost, me and Dave, how much money did you lose in that whole thing?
Oh, that's
$10,000.
Yeah.
Well, it pays to be conservative sometimes, but if you look at what Chris has done, making $2.5 million since Monday,
sometimes you lose out.
you're a little conservative and just bought your Amazon at its all-time high. We'll see. I think you're going to do fine in that trade anyway.
Hey, by the way, Jordan, and I've had other people send me the same question this week. They're like, is it too high now that I don't already own stuff? And I'm like, listen, the only thing I'll say about that is I don't believe there's any such thing as a hold. So I told Jordan this morning, I'm like, well, you think you just bought Amazon's all-time high, but so did I, because I am rebuying all my stocks every minute of the trading day. Every minute that I don't sell a stock,
you have to explain that because you're not rebuying, you're not buying, another $5 million worth of Amazon every day.
No.
By not selling it, you're mentally making the decision that you want to continue to own it
at that current price. So this second, I am making the mental decision to repurchase everything in my portfolio every second of the day based on its current stock price. So if someone's like, well, it's okay for you to own it because you bought it way cheaper, but I don't want to start buying it here. I'm like, well, I just bought it again a second ago because if I didn't like it at the price right now, I'd be selling it, right? So it's the number one mental issue that people have investing is they let their past gains or losses impact their current decision making, and that is completely flawed way of thinking. It's something that I learned as a kid. It's so hard to stop thinking like that, and especially when you watch CNBC and they're like, well, I wouldn't recommend this for new owners, but if you already have it, it's a hold. I want to put my fist through the screen every time I hear that. These idiots saying stuff like that. I mean, it just makes there's only one time. It makes
zero sense.
There's only one time that makes sense. When does it make sense?
Literally, when they had that show, I don't know if it's even on CNBC anymore, but that buy, sell, or hold show makes that was an infuriating thing. And this is the number one thing about getting your head around investing. It is either buy or sell. There is no such thing as holding. If you are holding a stock, you are doing the exact same thing as buying it that very moment at that very price. Holding doesn't make sense. You're just making the active decision to continue to buy it.
Well, the only reason to hold, right, would be that you've got long-term or you've got gains in that you don't want to pay taxes on.
Yeah, if you can make a conscious decision that you're like, well, I want to sell it, but I don't think I only think it's going to go down 5%, and I would make more money holding it to get that long-term capital gains in a month because I'm going to make 12% of the difference in taxes.
And so is it going to drop that difference in the next month or whatever? Then maybe that's
only time.
And so since we trade mostly in just standard accounts that don't have any sort of tax shelter, that we've got to think about those things.
Yeah. So that's it. That's the only time a hold makes sense. But by the way, that's not why people use the term hold. That's not why analysts use it. That's not why they use it because they're idiots. That's why they use it. They use it because they're idiots. And I wrote an art back in 1990.
I think that in itself becomes a clip for its own video. Analysts are idiots.
So I wrote an article in 1997 or 8 or 9, I don't know. And I sent it to remember when Motley Fool first came out in the 90s? I sent it to them, and it was this article. It was like buy or sell, never hold. There's no such thing as hold. And I just ripped the industry for it. And they the CEO, I think at the time of Motley, rejected the article. And I got into a fight with them over it because they wanted me to start writing for them because they saw the stuff that I was doing. I was like, I will not only not write for you, I will never, ever, ever pull this website up again if you don't publish it. And they wouldn't publish it. And it's just like, I don't understand why the industry is so set on this old conventional mentality of this verbiage that just doesn't make any sense.
Yep. Okay, so Steven's asking, Dave, your Amazon options would include earnings, right? One day after earnings. Is one day after earnings enough time to see the stock price rise due to good earnings? I bought them one day after, and it does include the earnings announcement and the following day. And generally, if there's crazy good news, the stock is going to react that next day at open. And if there's crazy bad news, the stock is going to react and gap way down when it opens. So it is enough time. And I bought those giving myself the opportunity to decide the day before, hey, has this risen as much as I thought it would? I will be deep in the money by then. What I'll probably do is roll those into a higher strike price, which would be a lower premium, and buy them with that one remaining day, same month, so that the next day, for a reduced risk, that lower premium, I'll have leverage over the same number of shares for that one day up or down, but with reducing my downside risk.
Yeah. By the way, that's me, and we do that all the time. We're constantly, when we're doing well, we're rolling our options up to different strike prices, because if an option that we bought for $40 is now worth $250, which it is, it might not be if Amazon's coming down right now, but it is. So me and Dave, right before the show, we were literally talking about, gosh, we literally just bought this yesterday and it's already time to roll the option strike price. We're going to sell that for $250, take that money off the table and repurchase another option for $50, so that if Amazon really gets hit here, the most we're going to lose is $50 now per share. And all that other money that we made on Amazon is in our pockets. It's our money. It's not going anywhere, right? Like that. And we've been doing that for the past 5-6 weeks, mostly on the way down. Now we're starting to do it on the way up when we purchase options. We're just going to roll them and roll them and roll them, and it limits our risk.
This is great. Guy is learning through our osmosis. That's what this is all about. Just leave us on, and you'll pick up some ideas or thoughts, and it's great. This is a unique point in time for inventiveness. I use this information for the basis of my thoughts, how and where to invest. I have learned so much from you. You guys are awesome. Thanks so much for watching. We really appreciate these kind of comments. Are you planning on going over spreads, or is that out of topic? It's really out of topic.
Yeah, Surrey, all right, fine. I'm going to get a new MacBook Pro, okay? Fine, at 1230. She said the screens look like 1080p, 480p, 1080p, and fine.
We're actually only streaming at 720, but Chris is streaming at like...
standard definition?
What is VGA? I think he's like plugged in through an old thing.
And I have such a nice setup, and it just, I try so hard, and, I'm gonna buy it. I'll buy it today. Done. I'll get it today. Dave, I'm gonna send you a picture of my setup today.
Okay, yeah, I want to see that. Merv is correcting me, so if you heard me say something incorrect, I apologize. Don't forget that each contract controls 100 shares, so the $6,000 discount would apply to the 2.4 million, not the strike price. Yes, that makes sense. If you, in context, if you remember that, that's. These comments are from a while ago. Let me scroll down to some newer ones.
I'm trying to get all the good ones. Will Holmes at 1234 says, question, if I buy one contract of CCL, Carnival Cruise, 1250 strike price, he's not telling me if it's a call or put, by the way. But okay, so if I buy one contract of CCL at the $12.50 strike at $5.40, expiring January of 2022. Whoa.
Or maybe January 22nd, but probably 2020.
And Carnival goes to 15. The most I'll make. Well, okay. No. If you buy the $12.50 strike and Carnival goes to 15, your option is only going to be worth $2.50, which is less than half of what you're paying for it. So here's a really good exercise we do all the time, guys. If you're paying $5.40 for an option with for the strike price of $12.50, this is a call. I'm saying it's a call. Then you need your break even. Okay, so Will, you need Carnival to go up to $17.90. So you add the strike price plus the premium at $17.90. That's your break even. It has to hit that price by the January of 2022 for you to break even. Everything above $17.90, you'll start making money. Now, that said, if it hits that price or anything close to it before January 2022, you'll still have a lot of time premium left, and you don't need it to go that high. If it even goes up $1 today, you'll make money. Just going up $1, you make money today. But if you're really going to wait this out till January 2022, you need to hit $17.90 just to break even. Okay, guys, that's part of the exercise you have to go through when you price these options out.
Yep. Hey, look who's on. Our buddy Len. He's saying that Jordan, your head is extremely yellow. I think that's your
Yeah,
hat.
I must have been looking down.
I don't see Lynn. Am I behind on comment? I don't.
Yeah,
you're
1234.
Oh, I don't see on my head.
Hey Lynn, if you want to join and talk about anything, just let me know. We'll patch you in. He's our partner in the bar and the restaurant that we always talk about.
Yes. And Lynn got a little, he's kind of like us. I mean, he's thinking this through, and he got a little nervous and sold out a lot of his stuff. And he did buy Amazon and Apple, which is good. And he has Zoom. And what else does he have?
Zoom is the only other one I know.
Oh, you know what Lynn did? I was talking to him for a couple hours, and he got all excited about Ford and pulled the trigger on Ford. He's in Ford now, but he really is not heavily in the market, so he feels kind of bad, like he's missing out the last few days. And that's the problem here, is that you don't want to overthink this market too much. You remember, at the end of the day, if you go back a couple episodes, the roaring 2020s is coming next year, right, Dave? Jordan,
yes,
and you don't want to completely miss out on that.
Don't want to miss out.
You don't want to be too light, right, in this market. Who are the losers in options? Sounds like there's more than one. That's Winnow, who just came in at 1238. Well, the loser, it just depends on what happens. So if you're making money on an option, someone else is losing money on the guy that wrote it to you is losing money. It's really that simple. If you lose money on the option, the guy that wrote the option is making money. It's just like buying and selling stock, guys. It's no different.
Yeah. And when you write an option, you're given money at the time you sell that option. Writing an option and selling, that writing is a synonym for selling. You get that premium up front, but you have the risk of losing if the stock doesn't go in the right direction for you.
Hey guys, can I talk? I do want to talk about one trade that I made already, and I'm going to continue to make. I'm really not feeling comfortable with my Google or my Facebook. I know I've talked about this. Yeah. I have sold most of my Google and most of my Facebook over the past couple weeks, and I'm considering completely getting rid of all of it, like right now. Like when we get done with the show, I'm thinking I might just sell off the rest. And here's why. I just don't like the ad picture here. Like I think the ad business is the one business that is just as bad shape as everything else, like restaurants and travel almost, and nobody appreciates that. And I think the market is really overlooking how bad this is going to get for Google and Facebook. And unlike a lot of these other companies that are paused, Jordan, remember we were talking about this? These companies that pause campaign, they will pause your contract. Yep. The reason why the Yelp is pausing your contract and giving you free stuff is because when things get better, they just want to unpause it and have all their clients back. Google, I don't think, can do that because they're not going to give out free advertising. So there are people that are massively cutting their ad budgets right now on Google and Facebook.
Yeah,
and they're going
saw
to
that
have
Barry Diller article and the interview on CNBC where he was super negative on advertising and a lot of other industries.
Expedia, spends $5 billion a year in advertising, and they're one of Google's #1 advertisers, and they're cutting their advertising from $5 billion to under $1 billion this year. I mean, guys, that's an 80% cut. Now, granted, they're a hospitality, they're a travel-related sector company, which is getting hurt the worst. But no restaurants are advertising, no travels advertising, right? I mean, these are some of the biggest sectors for advertising. I mean, and small business, right, is some of the biggest sectors for advertising on Google. I really just don't love them here, like 15% under their all-time highs, wherever they're at right now.
Absolutely. Here's a question related. Doesn't ads taking a hit also screw Roku, the future ad revenue? Roku is in a different situation, though, because they are a streaming platform. They're getting revenue from all of the services that are offered on there. I love Roku as a stock and actually as a product. I'm watching CNBC right on this screen over here on Roku right now because I don't have a DirecTV outlet in my attic.
But guys, who are Roku, who we think, and they're very secretive about their ad split, but who do we believe is Roku's biggest advertising clients right now? Disney, Apple, Netflix, right? And HBO, right? Like all these people, like
the people are trying to push their content. Why else would you advertise on Roku other than to, hey, come to our channel and watch our stuff?
Yeah, so they do have traditional advertising as well on the Roku channel in Roku, but I think
like TV commercials running through their cable ad buy.
Yeah, but I mean, I think, and again, I think a huge part of their growth and advertising base right now are just these content providers that are spending crazy money competing with each other, and that's probably part of the reason why Disney got 50 million subscribers. They're advertising on there's only a few places they can advertise where someone's going to see their show, and Roku's like what, a third of the market, a quarter of the market, right, Jordan? Didn't you do that work once, like Apple TV?
I forgot the numbers, but
I forget the number, but I think that the that subscription revenue from the services was it's north of 50%, maybe 75% of their revenue comes from that, and the rest is the smallest piece is like the set-top box expense, and the advertising is another smaller sliver. When we talk about Roku sometime, I'm sure we'll be talking about it again. We'll have better information for you.
Oh, hey, Brian Cruz at 1242. I just can't talk about this enough. With your calculations on restaurant, with your calculations that some restaurants may go out of business July or August, I'm surprised they haven't dipped more recently. When do you plan on selling your puts? So I actually increased my puts on Dave & Buster's this week. Not my puts, excuse me, my short position on Dave & Buster's. I know it's risky because you never know when there's a private equity shop that's going to come in here and be like, we don't care, we're taking it. They're raising $50 million by selling stock at the current price this week. I don't know if that deal got done or not, but I don't care. I don't care because I am not shorting restaurant stocks like Dave & Buster's because I think they're going to go out of business in the next 60 days. I'm shorting them for what I'm pretty sure is going to happen the following 120 days. So for me, it's about June, July, August, and September. That's when I think the restaurants are going to really be hurting when they're open and the government money has run out. And now guys, restaurants cannot operate more than 20% down for more than a couple months. So they don't need to be
on such thin margins to begin with that they will, even in normal times, if you saw your restaurant lost 20% of its traffic or sales, you're going to really struggle and probably not be able to operate for more than 3 or 4 months. It
was insane. Yeah, like once you get below like 25% off your business, like 30%, you're in deep trouble. And wouldn't you have to, in our scenario modeling, we're kind of thinking that restaurants for that 120-day period after the federal money runs out, we think their business is likely to be down somewhere between 25 and 60%, right? And so that puts them all in the red zone. And a few things is going to happen. The government's going to step up and give them even more money. They're going to be able to raise private debt, or they're done. I mean, I don't know how else to say it. They're done. And so I don't have like super high conviction, but I kind of have what's called medium conviction to medium high that a lot of them are going to be in trouble. And I don't think the market's appreciating how bad it is. As a restaurant owner, I see this world clearly. Okay. And so I'm not guessing. I mean, very few people on Wall Street truly understand what it's like to be a restaurant operator. They don't realize how horrific it is to do business at 25% off your revenue level. It's just not possible. You can't, it's not like a business where you're like, we'll just do less staff. You still need your kitchen. You still need your management. And guess what? Your staff, your waiters cost you almost nothing because they're like, you pay them minimum wage. They make their money off tips.
It's all tips.
So that's not where your money goes. Your money goes into like we pay $30,000 a year at our restaurant for like uniform, like get our towels washed and stuff. Like there's so many expenses that once you decide to open up, you kind of can't just cut it, right?
Yeah. You're not having to do your towel laundry right now, but you're paying a lot in rent for that giant facility that you have.
But Dave, once the restaurants open, they do have to pay for all of that stuff again, right?
Yeah.
And so I just don't know. And that's why I still kind of hate Yelp, because I feel like they might be open, but they might just like, we're not doing Yelp for a while. Like we have enough of our own customers. We don't need to like do advertising right now when we're losing money every month. because people kind of know who we are. You know, I feel like that's going to suffer. Cisco, I think, is going to continue to be down significantly. Cisco
Foods,
right?
Yeah.
So I'm still short Cisco. I'm really short Dave & Buster's, only because I think Dave & Buster's is like one of the most at-risk restaurant chains. I'm looking at some others, and we'll talk about that on Monday. But
yeah,
I don't know. We'll see what happens. And by the way, if I'm wrong,
there is an argument to be made for some of not Dave & Buster's, because it's all about getting in there and playing skee ball, and you don't want to touch things in a restaurant these days.
No,
but
finger foods, Dave. It's kids with finger foods and touching and like
And so that I'm out. But there is an argument to be made that the chain restaurants will be able to weather the storm better than small independent local restaurants on cash reserves and or ability to borrow money at scale. So some of the chain restaurants may thrive or survive,
but Dave,
over time, but it's still not a sector that I would want to be in.
Wait, let me throw a contrarian argument there. Don't you think that there's going to be a lot more community support for independent local restaurants over the chains, though?
No, I absolutely agree. Which is why Voltage LP saying that I watch Kramer. Yeah, sometimes I do tune into Kramer. I disagree with most of what he says. But I actually haven't watched him for 10 years. And so it's kind of refreshing to see faces you recognize on CNBC 10 years later after having just literally not watched it at all. Now I watch the market way more closely now than I have in the past 10 years. And yes, some of those personalities are still there. It's amazing.
Mark Ecker at 1247 is Ford a good buy right now before production starts up? We're not going to talk about Ford, because once we start talking about Ford, we're going to really talk about Ford. Okay. I was up, guys, till 3 a.m. last night, just deep in Ford research. Okay. And I want to talk about it on Monday. I'm still thinking about it. I'm still processing. But that is not a 5-minute talk. We're going to spend half an hour probably talking deep about Ford on Monday, because I just have a lot to talk about.
So we have that episode is scheduled and ready to go. So go hit the set reminder to remind yourself, or put it on your calendar, that we will be on noon Eastern, 11 Central, 9 Pacific.
Oh, guys, we have to Jarrett Spencer right before that, 1247 Disney. We got to talk about this though right now, real quick, okay? Because like this is one. It's my forever stock, Disney. Right? We did a forever stock episode, and I couldn't choose Amazon, so I chose Disney. Man, I love Disney so much. You'd be hard to find someone that loves that stock more than me. And guess what I did this week? I sold half of my Disney this week. I sold half. I sold half.
Yeah, I've got a little bit, and I was actually really looking to add to some after the initial drop. But then I started to think about it. In parks, are people going to be going to parks? Are people going to be going on the cruise ships? Are people... the sports is down. It's a big problem for Disney.
I sold all of my Disney yesterday. Yes, because if there's no such thing as holding, you're making the decision that you want to buy and own Disney, but just less of it than you had before. So I got rid of it all. Yeah,
and that's where like I can't. It's so crazy. I can't sell it all. It's so irrational. It's so irrational. But I can't sell it all because I'm so attached to that company. But man, I think, Jordan, you're talking about 40% of their parks is 40% of the company. Zero. I know. And not only that, ESPN is in major potential trouble right now. Major issues with their cable, their advertising. Oh, horrific. Disney Plus, they're not really making any money there at all. It's irrelevant, really, right now.
Right. Well, they took on huge debt to be able to finance Disney Plus and to build new cruise ships, right? And
they're really levered right now, but that's okay because it's Disney, and Disney will be able to lever up as much as they want. And if they want more, they can get more. So I'm not worried about Disney going bankrupt, but I am worried about when like the impact of their earnings being potentially way worse than the market. You see, the market, I think, loves Disney like I love Disney, and they can't cut through the fog. It's already down 30%, whatever it is, right? 30%. And like, are they going to really cut it in half? Like, and so I'm not saying it's going to get cut in half. I'm not saying it's going to 70 or anything, right? But I would love for Disney to drop $20 and to buy in like in the 80s, right? Like I would love to like.
Right, if you could rewind time and pick it up when it hit its lowest at 86, maybe
I think
that's
it's
the
one
right
of those-
price.
Then why don't you sell some 80 puts?
Oh my gosh.
Take some guaranteed money, and then also be able to buy it at 80 if it ever goes to that.
Right.
You know why?
You've just made profit without
Yeah.
any risk, and if it goes to 80, you bought it at 80. If it goes to 60, you still own some at 80.
You know what, Dave? If there was ever a time for me to sell puts, this would be it. This would be it. And I'm not saying I'm going to do it, but I'll consider it. I'll look into it after the show today, because if there's ever a time to do it, this would be it for me.
I can tell you that I own some Roku stock, but I would like to own more, but I don't really need it. So I sold some Roku puts for guaranteed profits and to own it at a price that I'd be completely comfortable owning it. I also have sold puts in Crown Castle, that REIT for cell towers. I own 500 shares. I'd own 500 more if it went down to $150 again. It's at 162 now, but if it went down to 140, I think 150 is a good price for that REIT. So I would double down and buy more. But I have guaranteed profit if it stays up.
Yeah, and by the way, let's remind everyone, Chris Erickson says 1252, be careful what's selling to open call. Like, we're only talking about, for the most part, going long calls and puts. Like once you start writing options, guys, that stuff is so risky. It is likely not something that anybody should be doing unless you're more sophisticated.
I'm uncomfortable with it, and I understand it really well.
Yeah, and listen, any option at all. The options are not something you just kind of hop in and you need to spend some time, do some paper trading, learn it before you do it, and speak to your financial advisor if you need to make sure that your risk tolerance is appropriate for options. Because listen, again, don't mimic what we're doing. We're at a very different risk tolerance than a lot of people out there.
I think that paper trading advice is great because you can go in, look at the bid, see what you would have been able to buy that for, and then wait a few days, go look at it and see what you would be able to sell it for, and just like see where you won, see where you lost, and start to learn, I would have lost all my money had I done that. I would have doubled my money had I done that. And it's really a good way to kind of tiptoe into options for the first time. When you're talking about, it looks like we had some comments of other restaurant stocks to consider. Chuy's is a publicly traded. It's a smaller chain, but I think feels more local.
You know what though, man? It's one of the only meals that besides my own restaurant we order in is Chuy's, because everyone's loving Mexican right now. Like, because you can't make Mexican food, you can't really make at home. So a lot of, like, in our neighborhood in Dallas, Texas, the Mexican restaurants are like the only restaurants that you can't even get delivery windows because they are going nonstop. Like,
but they also deliver margaritas, which is a pretty big reason.
So does Chelsea Corner.
only in Texas. So, interestingly, I had Chuy's delivered through DoorDash yesterday or the day before, and it said it was like a 23-minute turnaround. Then I kept getting updates. They were so backed up, it took an hour for it to get here. They still didn't cook it, and it got to my house within 10 minutes of it being made. So the delivery system was working, but their orders were completely backlogged.
Yeah, so if I'm going to short a restaurant, I'm going to short business lunch places, right? Like steak places, and sit down sit down restaurant that's not Mexican, basically.
Look, this is one to show. I don't even know if Chuck E. Cheese's is a public company, but if it is,
Crockett, is that public?
That's Michael Crockett. I don't know, but yes. And this is interesting. I tried to short play yesterday, but Schwab told me they don't have enough shares to loan. That's
are they 100%?
Who?
But here's the thing. I've also gotten that warning, even trying to short the SPY through Schwab. They basically charge you a fee to short a hard to borrow stock. So maybe they're not letting you short Dave & Buster's anymore. That's interesting.
Is it? I think Chuck E. Cheese.
Do you want to quickly go over the difference between what a put is and what a short is, or I can while you're looking at Chuck E. Cheese? A put is basically
what it is. It's why would you choose one over the other, right? And
well, a short. The biggest reason why people will choose a put over a short is a short has unlimited loss potential.
Yes, the stock could go to zero, and you could lose all of your money.
No. If it goes up, no, I'm saying it has. No, if you're shorting it, it could go up. Technically, it could go up infinitely. And by the way, it's not a theoretical. It actually has happened a couple times. Once with Volkswagen, I think it was a few years ago. Was it Volkswagen or Porsche that it went up like 30x? It was so insane. It was a short squeeze that people kept buying it, and there was no way to cover. It's very rare, but there is a theoretical risk when you short a company that people can squeeze you and you can't catch up with it. When you go to buy your shares back, they'll make, if it's not very liquid, they will force you to pay the most insane amount for those shares. And meanwhile, you're making $1,000 investment, you just lost $100,000 on, right?
Because when you're short a stock, you have to cover that stock, and there is a threshold that they will allow you to go. And once you're it's basically
there's securities
trading on margin.
Well, there's securities laws around this, right? It's 1.5x, right?
It varies by stock. So some stocks are more, some are less. But there is definitely a threshold that you're required to buy that back based on the equity in your account. And so, yes, that's what a short squeeze is. And that's why a put option is less risky, because even though you can lose the entire to have an unlimited loss, you're just going to lose whatever you invested.
Yes. And by the way, on, stocks on a put option gets you leverage too. So the short, the most money you'll ever make on a short is the amount of money you invest if it goes to zero. If you invest $1,000 on a company that's trading at $8 and it goes to zero, you made $1,000. But you can buy puts and potentially make 5 or 10 or 20x leverage. So on $1,000 put investment, you might make $10,000 theoretically, right? So those are the primary differeces and why you'd want to look at one over the other.
And it looks like we're coming up on the 2-hour mark. Thank you guys so much for staying with us the whole time. We've had so many viewers, so many comments, but I think we need to cut this one. And we're going to be back on Monday with that episode that we keep talking about, where we're going to be showing you the things that we're investing in that we think people are spending their stimulus money on. The best way to profit from people spending their stimulus money. We also have to remind you, let me see if I can pull my graphic up again.
Dude, Monday's episode is going to be hot. Like I can't wait. Like it's been a while since I've really looked forward to an episode. Like I'm really looking forward to this one because it's just fun. I've been doing the research. I have a lot of ideas. I want to talk them through with you guys. I want to hear comments. I want to hear. By the way, if you guys have any ideas for Monday's episode,
we're coming with ideas, but you can leave comments in this episode in the comments that are under the replay of this episode, which will be live as soon as we're done. Leave comments about your ideas, because we're going to be talking about the thing. We're going to each come with ideas. We're going to be looking for the chat, and if you have anything that you want us to research, let us know in the comments.
Absolutely.
And be sure you, there's the new smash the like button graphic. Smash the like button. It does help us out with the YouTube algorithm. Ding!
Great
weekend, not already subscribed. Guys. We want you to subscribe to both of our channels, Dumb Money and Dumb Money Live. Also my other channel. Hey there, Dave here. Thank you guys so much for watching. We are Dumb Money. We will see you on Monday.